Good morning, ladies and gents, and thank you for taking the time to join us for the second multi-asset update of 2022. I think today might not be as easy as it was in the past with markets falling all around the world, but I hope that you find this session insightful and that you see the value in our process. Understanding that we don't and we will never try and forecast what markets will do. We try and stick to our knitting of systematic investing and base our decisions on what the data is telling us. I'm Davy Carstens, for those that don't know me, and I'm joined by our two co-heads of multi-asset. Most of you will already know Rupert, but I'd also like to welcome Odwa to his first multi-asset webinar. Odwa has been with Prescient since 2015, first with the securities business, and then joined the Prescient Investment team in June last year as part of the multi-asset team and then co-head. Just as a reminder, all of our multi-asset funds are run on exactly the same basis. Balanced fund has the longest track record, but we also have a low equity version called defensive and a global balanced fund. I think all three of these funds can be used as a low-cost call to any portfolio. We don't see any of our funds or multi-asset funds as a passive fund. I think the only passive element to them is a low fee, being only 30 basis points. On the housekeeping side, please feel free to ask any questions on the Q&A function. We'll try and get through as many of those towards the end of the webinar. And then CPD points. Everyone who's attending the full duration of this webinar will receive CPD points. As soon as we get the sign-off from the FBI, we will send out those certificates. And with that, over to you guys, Rupert and Odwa.
Thanks very much, Davy, and thanks everyone for tuning in today. I mean, as Davy says, Q1 was actually relatively easy as a webinar update. Q2, somewhat more difficult with the world having changed, especially in South Africa. I think it's interesting that Q1 we were largely immune to what happened in the world, global markets, but Q2 we certainly haven't been. So things are changing. We're going to take you through quite a few of those changes. But first off, I thought I'd just, for those that are new, go through very quickly what the investment philosophy and process Prescient and then the balanced fund is. So we are a rules-based house. We are systematic, and we're based on large amounts of data. We see ourselves as being rational, rules and evidence-based and data-driven, which leads to unbiased decisions, clear strategies and processes. So everything that we will talk about today feeds in some way, shape or form into the models that build the portfolios in which you invest. And I think that's very important. We're not talking about things in an abstract sense. We're talking about things in a practical sense. That then we believe, and has evidence from the balanced funds track record and other funds that we manage, gives you consistent long-term outperformance. And that's what's key, that consistency through time. So how do we do that? I think the key points of this are summarized in these 5 blocks, but we're guided by numbers. We use the power of time, proven investment processes, team humility, and peace of mind. So for me, very important to follow all 5 of those practices over time. That delivers exactly what you need as an end investor. For us, the important part is asset allocation. We aren't stock pickers. We invest at an index level where we do use a degree of individual picking, if you want to call it that, is within the fixed income market. You'll know Prescient is a fixed income house, so we do make duration calls, for example, credit calls, but we don't pick individual equities. Over the long run, that we believe accounts for over 95% of performance within the fund. Just to highlight 2 things, I think we all are very aware of this. These are the ASISA multi-asset categories, so not our funds in particular. But just to highlight, in the shorter run, and we were in the same period a couple of months ago, in the shorter run, multi-asset high equity has underperformed income. And that's something which we've seen in a market sell-off. It's happened before, it will happen again. Income definitely has a place within a portfolio. That's why we look to structure portfolios across asset classes. But for a multi-asset high equity portfolio, it's more about the long run. It's about a pension fund investor with 5, 10, 20 years to retirement, and then even post-retirement. And for that, you need equity upside. And that's where we try and get this mix through the long run to beat that same line chart of a CISA multi-asset income with high equity exposure. We have diversified sources of alpha. We'll go through those in a second, but the important thing is the dispersion of returns within the category. The Prescient Balanced Fund looks to provide average returns or just above average returns compared to the multi-asset categories, and then to compound that through time to deliver that consistent outperformance. One of the key charts that I like to show here is the importance of fees. As Davy mentioned, we're at 30 basis points management fee, 54 basis points TIC, and the importance of fees I cannot stress more, because if you look at the relationship here between TICs and 5-year annualized returns on a rolling basis, there's a definite relationship, and that relationship is simply that if you can save on a TIC, you generally will make more on a fund. That's in general. There are definitely outliers, some great active pickers out there, but for us, the importance is to minimize those fees and those associated costs. We're not a passive fund. We are an active fund, but we do so through efficient exposures to asset classes. So end of the day, that brings us to the best of both worlds. I think, again, you've all seen this, or most of you have seen this before, but best of passive and active. So low fees, low transaction costs, low tracking errors to the peer group. And then from the active side, we like to have an efficient allocation of capital. That's our long-term structural foundation of the portfolios. And then we capture shorter-term market dislocations. That's using our in-house models on asset classes. And then we look to deliver fixed income alpha rather than equity alpha. So those combinations are in essence the Prescient Balanced Fund. And as Davy said, we run other funds within the same strategy, just different targets. So the Prescient Defensive Fund and the Prescient Global Balanced Fund being within that family. So that's basically the fund philosophy, how it all works and how it all fits together. But I think the importance now is to go into where we sit amongst our themes. So we have quite a few themes on the go at the moment, but there are 2 or 3 new themes, one being into the global storm. We have seen a lot of increase in negativity coming into the second quarter, some serious negative numbers printing across asset classes. So we thought we'd dig a bit deeper into that. And then higher real rates. So in this case, we're seeing extremely high real rates, especially in the differential between the US and South Africa. But even within South Africa, very attractive fixed income markets on a real and on a nominal basis. So just to go into the global storm in a bit more detail. So what we've seen over the past, let's call it 2 months, has been a declining global market environment. From a couple of things. There's a bit of, let's call it confusion within the market, I would say. High inflation, uncertainty, probably a better way to call it. Uncertainty within the markets has led to a general sell-off. Is this going to be a prolonged period of high inflation leading to a stagflation type environment? Are we in a period where we're going into a recession? All of those questions are on the minds of investors right now. So let's dig into a couple of the indicators that we use to guide us around this exact concept. First one being the Prescient Economic Indicator, which is an aggregation of many different variables to, in essence, estimate the current GDP growth rate versus trend of different economies. So in this case, it's the United States. If it's 0, it means that you're on trend. And if it goes below 0, like it's been doing recently, it means that you're going below trend, which means that there is, as a front runner to the prints on GDP growth in the United States, what we can see from this indicator is that there has been a declining global growth environment, certainly from the United States' perspective. So definitely a degree of negativity on the cards from the Prescient Economic Indicator perspective. But if we look at recessions historically, what do we see recessions as having been categorized by? And this is also, it's not just us, it's National Bureau of Economic Research in the United States. They categorize a recession using some independent variables, 2 of which are shown here. The one is the unemployment rate, which is near all-time lows in the United States. And the second one is wage growth, which is near all-time highs. And yes, that's in line with inflation. It does pick up with inflation. But let's just go through what the previous two big sell-offs looked like. So we saw wage growth coming off, and we saw unemployment going up, right? That was 2001, 2000 and 2001. 2008, wage growth comes off, unemployment goes up. So very similar patterns. What we've seen recently, though, is unemployment going down and wage growth going up. So just an interesting flip side to the coin, where it's not a normal recession, if you want to call it that. We are seeing a slowdown in the global economy. Some of our indicators have switched, but there are others which are showing quite a strong global economy. So a bit of a on the fence view from that standpoint. If we look at the yield curve, this is a model on various points on the yield curve. So usually you would say there's yield curve inversion if it's like a 2-10-year spread, which then goes negative. What we've built here is a model which shows, in essence, the entire yield curve and the spreads from one point to the other. What you need to see here, though, is the upward sloping yield curve, which is shown in blue at the front end of the yield curve as we currently see it, and relatively flat yield curve from there on out. What we've seen in the past is a highly upward sloping yield curve, downward sloping, and then upward sloping again. And then that pattern is something that we're not seeing in this case. So a very aggressive Fed hiking cycle that's been priced into the market. But at the back end of the curve, we're seeing a very flat market, if not a decreasing yield curve. So what that means is that the market is pricing this as being largely temporary. That said, if we aggregate all of those indicators, you can see this line here has picked up. What this is, in essence, is the probability of a recession. So we're not sitting as ostriches with our heads in the sand. We do see that there is a probability of recession picking up. We're seeing it roughly at 50-50 right now. That recession, we think, at the moment would be quite shallow, but that does certainly change through time. And then just one last one here, from a monetary policy perspective, if you look at the velocity of money, this red line here, what this shows us is that the intervention from the central bank in terms of quantitative easing and quantitative tightening, and we've seen this before, is not nearly as effective as it was previously. So if we were to have a change in monetary policy from a central bank perspective on monetary tightening or monetary easing, it's not as effective as it was previously. So what we're looking at, in essence, is the rate hike cycle as the primary input. Inflation, I mean, we've seen this as being massively overshooting what the majority of us have expected, sitting at 9.1 at the most recent print in the United States. It's far higher than it has been in the last 30 years, but we think, and so does the market, that is still temporary, transitory, if you want to call it that. And just to show you how that looks, this is that same number, 9.1, the latest inflation print, which is a backward-looking number. And then if we look at what the inflation swap market is doing, it's come down significantly. So now to 3.4, which means that the market essentially just isn't buying it, which means that the market at least is seeing this as a transitory environment for inflation. The very last one that I'll show you on this topic is just the retail slowdown and the general slowdown in China. We saw a lockdown in China, which has since opened up as the waves of COVID passed through them. Interestingly, the retail sales went down significantly during that lockdown, but have come back into the positive territory since then. So there is the potential for a pickup back to a normal global growth environment from an Eastern economy perspective from China. So that's the global economic environment. I'm going to hand it over to Odwa now to discuss how we're looking on the rates and where the market is pricing on rates versus the central banks.
Right. Thank you, Rupert, and good morning to everyone. So on our side, I'm just going to quickly go to our income page and to spend a few minutes getting a sense of where we see interest rates going in South Africa. All right. And as well, we'll also look at it from a global perspective as well. All right. So as Rupert mentioned, with the advent of super high inflation and reserve banks having been to forced to make moves to try to combat and quell the inflation fires in order to retain their credibility. We've seen a lot of rate hiking cycles. And South Africa has also started joining that band of central banks that are hiking. So what I have depicted over here in the red dashed line, so this is our current 3-month JIBAR. So this is how much you can currently borrow for a 3-month term. So, and what we also then have in this chart in blue, these are forward expectations as priced by the market, as where they see interest rates going from here. So what we're seeing here is that currently we're sitting at interest rates of around 5%. So just slightly above where the current repo rate that's set by the Reserve Bank currently sits. And then from a forward-looking view, what we start to see is that the market is expecting a lot of hikes. So as an example, if we go all the way till December, what we are currently seeing is that even though rates are currently around 5%, the market expects interest rates to have increased to 7% by the end of the year. So maybe to think about this, that's about 2% increase in rates, or 200 basis points. And the South African Reserve Bank monetary policy meetings, there are only 3 of those scheduled for the rest of the year. So one is on Thursday, and I think one is in September and another one in November. So what really this is indicating is that the market expects 200 basis points in 3 meetings. What this really then sort of suggests as well is that like at least one of those hikes can be for about 75 basis points, which is actually quite a massive hike. But again, something that we've seen even in the US quite recently. So, I mean, from a homeowner's perspective, or anyone with debt, which is a lot of South Africans, this actually does pose quite a shock to the system. And moving on from December until, let's call it the same time next year, so July next year, we're expecting a further 1% hikes to take us all the way to 8% interest rates. So it does really, from a consumer's perspective at least, does actually seem like there are some hard times coming through. And with the backdrop of also having a difficult economy, that might not necessarily spell the best news from a consumer perspective. All right. However, from an income generation perspective, you can almost see that there's quite strong interest rate earnings that one can generate going forward. So having mentioned that, it also would be nice to just contrast with what we're expecting from our central bank to what we are seeing offshore. So let me just turn this off. So what this is on the right-hand side, this is what the US Federal Reserve is expected to be doing. So what we're seeing are interest rates currently sitting at between 1.5% and 1.75% range. And what the market is also expecting are quite steep hikes in interest rates from the US Federal Reserve. But interestingly, if you look at the peak as to where they expect rates to actually stop increasing, is at 3.4. So we are looking at perhaps another 2%-ish of hikes until the end of the year. So that again is also quite aggressive until the end of December. But what is actually quite surprising in the United States is that, they are hiking by 2% to fight inflation that's sitting at above 9%. Whereas in South Africa, we are slightly above our upper range guidance, i.e., by all measures, it doesn't, there's no evidence as yet that says inflation is out of control, but our hiking is actually quite aggressive. Another interesting with the US, point about the US is that by around this time next year, so around June, they also expect that the Reserve Bank would have started to cut interest rates, right? So again, this just goes back to highlight that no one really thinks the high inflation globally or in the US is going to be entrenched, given that they expect rates to actually start coming down after this aggressive hiking which again will go a very long way to quell the demand that could fuel inflation, even though currently what we're seeing is inflation very much driven by supply bottlenecks and high energy prices, as again from the unexpected developments that we've seen in Europe with the Ukrainian and the Russian war. So all in all, what it also indicates, maybe from a South African perspective, is that perhaps the market is a bit too pessimistic about the path of interest rates hike going forward. Again, given that we're sitting at not inflation that is way beyond guidance from what we've seen, again, from the Reserve Bank. So again, this is not a picture that might necessarily be realized. However, it does offer an opportunity to take advantage of these high interest rates that are being priced, especially if you start looking out more than a year out into the future, and they may not materialize. Again, given our economic reality, that if our prices remain stable and not blow out beyond the guidance that we've received, there may not be reason for the Reserve Bank to act beyond what is required. So that's really sort of like encapsulates the two markets and what we're seeing as the theme. So one, yes, there's rate hiking expected to peak at around December from a US perspective, and we expected to peak around next year this time, when the most of the hikes are expected to be have been realized. However, this could be earlier if, again, the market is just being too pessimistic about the path. But what's also quite pleasing is that there are some rate cuts that are expected around this time next year, which again is just to support the view that inflation will have quelled by then, right? And then will be in a much better position going forward, right? I would like to hand over to Rupert again now, just to maybe take us through the equity markets perspective.
I think also what's quite interesting, just on that point, to highlight, bring it back to the first point that I made, in that perhaps quantitative easing or quantitative tightening not quite as efficient as it was previously, or effective as it was previously. But with the Fed aggressively hiking like they are, if Fed funds rate sits above 3, it means they've got powder in the gun to cut rates should the recession come through. So that's an interesting, if you look forward 6 to 12 months, that's essentially what the market is starting to price. And that goes back down to the long-term, or just above the long-term Fed funds target of 2%. So basically normalizing, but through cuts. So it's an interesting concept. We're all focusing on the high inflation prints, but what happens when the back end of those one-year inflation numbers rolls out? The inflation numbers start to come right back down. So it's a good space to be watching on that front. Okay, so that's just a general macroeconomic perspective. I'm just now going to go into South African equities and US equities in particular, but let me first take you into our overall view on asset classes. So there have been some changes since our last chat, and I'm just going to take you very briefly through them. But the interesting part of these changes is that risk has come off within our models. So previously we had strong overweights in South African equities, South African bonds. A couple of months before that, we had the Rand as a strong overweight. We had SA property last year, all of those being growth assets, South African centric. What has come off to a moderate overweight, which is not, it's still bullish, it's just not quite as bullish as we were previously, South African equities, South African nominal bonds. What's gone to a strong underweight? US equities. So those two are what I'm going to cover today, South African equities versus US equities, but some interesting changes in our asset class models, shifting towards a more bearish stance, not completely bearish, but certainly a bit more bearish than we were last quarter. So digging into South African equities in particular, what we're still seeing here, and I'll compare this or contrast this to US equities, we're still seeing an extremely strong value case. So as a reminder, our models for for tactical asset allocations within these funds based on large amounts of data, but all logical indicators, the same things that other asset managers follow. We just do it in what we think is a very efficient fashion to distill down these signals into asset class views. So when Odwa talks about yield curves, that comes into these models through an indicator on the economic side. We split them out into 4 families of indicators: valuations, economics, so that's economic growth; financial conditions, that's the conduciveness of financial markets towards trade; and then sentiment, which is also very important within markets. How willing are people to buy into these equity markets? So from a valuations perspective, still very, very attractive for South African equities, and has been so for quite some time. So even though there has been a market sell-off, we've seen stable earnings profiles. In fact, we've seen positive earnings prints from a lot of the resource companies in South Africa, which has been buoying up the South African valuations indicator. The economic picture in South Africa is also still marginally positive. It's a bit of a split, but we're seeing still semi-positive economic surprises. So those are indicators which publish ahead of analysts' expectations. Profit margins are still strong. Labor market extremely strong. This is in the United States labor market, which I covered earlier. Prescient economic indicator, that's the now cost of growth, that's starting to turn to neutral. Odwa is going to cover in a bit more detail the financial conditions factor, which certainly has switched towards a more negative stance of late, and then sentiment sitting on a neutral stance with a bit of a mix across the indicators. Does this work? How do we assess this sort of model? I mean, if you look at how the distributions work here, if you're strongly positive, it means within our models, it means that we take an overweight within the funds. The strongly positive signals strongly skewed towards the right, which shows that we have a much higher probability of a 1-year forward return, which is above market expectations. Same thing on the downside, strongly negative, strongly leftward skewed. And that's how we look to build these models. So from a valuations perspective in South Africa, why are we so positive from a value perspective? So here we're looking at index level indicators like price to earnings, price to book, price to sales. If you look at the price to earnings ratio on South Africa through time, you can see the latest print being almost the lowest print we've seen since the 1990s, showing that the earnings profile in SA equities, given the current price levels, very attractive. Sitting around 10 means you've got around 10 years until you get paid back the investment value of your initial capital. And then if you look at it on a forward PE ratio perspective, I mean, obviously the PE ratio is backward looking. So what does the forward PE ratio look like, which embeds a growth assumption, also looking very attractive for South African equities, even lower, in fact, than the standalone PE ratio. So from an analyst perspective, on the street, if you like, people are still pricing South African equities as having quite a strong growth outlook. Price to book, quite a similar picture, below the long-term median, a relatively attractive market. Price to sales, also below the long-term median, quite attractive. Relative yield, quite an interesting one. This is relative yield versus the MSCI World, also very attractive. So for an offshore investor, simply from a valuations perspective, South African equities still look very attractive. That's not the be-all and end-all of our models, though. And as mentioned, there are also things like financial conditions, which have been turning a bit more negative of late. But I think to contrast this one, I just want to go into US equities. So US equities, quite a different picture. And we've been underweight on US equities for a few months. We've now gone over the last few days into a strong underweight. And why is that? Well, the economic conditions have, the economic growth picture has been deteriorating in US equities. And that's on the back of an already very overvalued US equity market. So we've seen this overvalued market for 2 or 3 years now, but it has been justified by quite strong underlying economic growth. So in essence, the companies grow into those PE ratios. The change now is that the economic picture has degraded into a negative one. We're seeing, as I showed in the earlier chart, Prescient economic indicator now going negative, which is showing a high probability of negative growth prints in the United States. Economic surprises, negative on the downside. yield curve, downward sloping, still a strong labor market, which I did cover, but that is something which is merely a cog in the wheel, and there are many other things that we look at, and we look at these things on aggregate. Odwa is going to cover the financial conditions, but in the sentiment side, business sentiment, consumer sentiment, both relatively negative. So the United States not looking all too rosy right now, and something which we've traded towards in the funds over the last few days is an underweight in US equities. So that's my take on the two equity markets. I'm going to hand back to Odwa now just to go through in a bit more detail these financial conditions factors that we see.
Right, thanks, Rupert. So the financial conditions, really, they underpin a lot of our risky assets or growth assets. So that includes emerging markets, equity markets as well. As we've seen here, on aggregate, they've turned to negative as of recently. And what we'll do is just spend some time going through and a lot of them. But the key takeaway here is, as one of the pillars or lenses that we assess the markets from, they've actually have contributed to taking off a risk that we've seen in nominal bonds and SA equity, and have also amplified the negative view on like US equities as an example. So let's just go there quite quickly. So what I'll do is I'll just take you through the credit spreads, funding pressure, and finally look at the cross-currency basis to see how those measures have evolved. So what we have over here, essentially, we have our credit spreads over time. So we can think of this as the cost of borrowing for corporations across the globe over and above the base rates, which would likely be, let's call it, your risk-free United States government bonds. So what we've seen recently is an increase in the credit spreads to above their long-term median levels. That means that it's now costing businesses slightly more from a funding perspective to do business. And this will either have impact on their profitability and perhaps even on, their willingness to actually expand at the higher funding costs. Another interpretation of credit spreads, as I mentioned, given that these are usually spreads relative to what is considered a risk-free investment, such as United States of developed market bonds, is that this is also perhaps a measure of risk that is being perceived by the market. So the higher the credit spreads, it's then investors are seeing a higher likelihood of companies not being able to repay their debts back, right? So that's another interpretation, which again is not a positive from that perspective. So again, therefore, this contributes negatively to our view on taking risk in portfolios. Another measure that we now look at, so credit spreads looks at the broad corporations. Here we're looking a bit more closely at the financial system, and in particular the banks. So our funding pressure is measured as the spread between LIBOR and the overnight indexed swap. So long story short, what LIBOR is, banks lend money to one another, but they also exchange capital, right, when they lend money to one another. But bear in mind, these are the banks with the best credit ratings, even better credit ratings than a lot of countries, in fact. Then the overnight spread. So this is when the same banks lend to one another, but they don't exchange any capital. They only exchange the interest that they owe to each other. So the LIBOR, if a bank defaults, you lose the interest that they owe you, and you also lose your capital. Whereas under this OIS spread, if a bank defaults, you only lose the interest that they owe you. So what this then, the difference between these two essentially measures the credit risk that is embedded in the financial system, or maybe in another way, it also looks at the risk of contagion. When things go wrong in one sector for one bank, they might spread to the entire banking sector, which is the risk that we saw around the financial crisis, which then blew up again with the default of Lehman as well. We saw a sharp increase and a sharp decrease again in this measure around COVID, given that there wasn't deemed to be persistent systematic risk. And more recently, with the outbreak of the war in Russia and Ukraine, again, we saw similar risk starting to creep up. Again, given that a lot of banks have exposures to these commodity producers, either in Russia, etc. But that did come down eventually, given that, again, Russia and Ukraine, from a global GDP and trade perspective, they were not forming such a huge percentage of the global economy. Therefore, it didn't really pose much of a risk from a financial perspective, even though it is a tragedy from a humanitarian perspective. But what we're now seeing is a slight uptick again in this funding pressure, which is above long-term median levels, which again is weighing a bit negatively from this, again, contagion risk type of lens that this measure really speaks quite well to. So again, this is well, weighing again on the positive views that we had on some of our asset classes. Then finally, we look at cross-currency basis. Simplistically put, this measures the shortage of dollars, let's put it, in the financial system. So you see there, there's a, like, let's call it a baseline of 0. The more negative this number goes, right, the more dollars that are being hoarded, or i.e. are not being utilized in the financial system. So that's one of the reasons, as an example, we've seen the dollar strengthening quite substantially against other, even developed market currencies. There's just been this, let's call it, hesitancy of financial market participants to be deploying those dollars. So case in point, even if we look at South African equities, which look quite attractive from a valuation perspective, but if people are not willing to be putting their dollars in emerging markets or and in other parts of the world, those valuations can remain attractive for a while until that risk on then returns, and then people are less are not holding on to their financial capital or their hard currencies as they seem to be a lot right now. So we quite see that this confluence of factors, actually, they do dovetail and mirror one another. And even though they might seem, we might say equity is cheap in South Africa, what we're seeing from the financial conditions perspective is that actually there might be a reason, right, for that, that we're not seeing a recovery from that sense. And these are the factors that actually play quite a strong role, again, from a global perspective, rather than looking at South Africa in isolation. We also always have to think that, recall that, we're part of a larger global financial system, and all of the global activities do influence us on that side. Right, cool. Rupert, over to you again.
Cool. So that just gives a bit of context as to why some of our models have been switching towards more of a, I'm not going to say a negative stance. In the United States, we are strong underweight, but remember, in South Africa, we're still positive, just a little bit less positive than we were before. So that's how our models work. We've shifted in SA from a strong overweight to a moderate overweight, and in the United States, we've shifted to a strong underweight. So just to show that the cogs in the wheel are turning, and we are keeping track of all of these things. I think a very interesting concept just in the fixed income market, and how just to talk around why the performance on some of the funds has been impacted a bit from spread widening. Just to give context on asset classes year to date, very, very strong negative prints in performance. So this is 2022's year-to-date performance. Basically nowhere has been safe except inflation linkers in South Africa, and even that's hardly made a lot in terms of overall returns. But being a fixed income house, we actually see a very, very strong alpha generation outlook from here on out. And why I say that is that the instruments that we hold are extremely highly rated, so extremely high credit quality if there is any credit risk whatsoever. Some of it's, or a lot of it's, government guaranteed. And those instruments are now offering spreads over cash, which haven't been seen since the 2008 financial crisis. Let me just take you through that on the shorter term cash side. So if we look at simple 3-month JIBAR, which, as Odwa showed, it will pick up with the SARB's hikes, but we came into 2020 with a prime rate sitting around 8 or 8 and above %. That's something we have seen before. So it's nowhere near, we haven't quite got back to where we were pre-2020. The thing that's been increasing, though, is the spread. So if we look at the 1-year NCD, so from a perspective of instruments that we can hold within our portfolios, we can either pick 3-month JIBAR for cash, or we can take out to 1-year NCDs for cash. Now, generally what we do within our portfolios is we take the 1-year NCDs as an example to give us pickup over cash. And that's where we get a lot of our alpha profile within the portfolios. That has hurt as yield spreads have been increasing. But within the fixed income markets, that means that from here on out, we earn to maturity 2.6% yield spread over cash. So simply by taking that slightly longer term, we've got an extremely attractive market right now, which is our alpha profile and how we deliver alpha within our funds in general. If we look at more of a duration perspective, so looking a little bit more on the duration, here's relative duration, if you want to call it that, between SA and US on a real 10-year interest rate spread, that's sitting at all-time highs. So from an outside investor's perspective into South African bonds, very, very attractive. And we all know the rand has sold off significantly over the last couple of weeks, which makes it even more attractive, even more cheap for people to buy into SA bonds. That obviously comes with a cost, and what we need to see within this market is that the risk comes back on within global markets. But it just goes back to this inflation story. What is the market pricing in terms of inflation? Inflation swaps pricing all the way back down almost to the 2% mark where we were normally. So the inflation story we still think is going to be transitory. Whether that's transitory in the here and now or it's got a couple more months to go remains to be seen. But the inflation story, we think, is not what's going to drive markets over the next year or two. What's going to drive markets is the economic growth picture. And that's one of the indicators from an economic perspective I showed you has been changing. And that's where we see ourselves at the potential risk of recession in various economies around the world. So that's just to highlight from a prescient perspective on our portable alpha process and how we make a duration call instead of picking equities, where performance certainly has hurt of late. And that's something that we have been spending a lot of time on and concentrating our efforts on and seeing how we can improve that. So that said, you can look at the various performance periods. Us versus our benchmark over a 1-year period, certainly not as great a performance as we would have liked. But unlike an equity fund where we pick stocks and then we get the stock calls wrong and then we reset to pick some more stocks, we pick fixed income instruments where the yield to maturity is now locked to maturity. So we expect that alpha profile to reaccrue as we go through time. So I mean, it sounds like a serious sales pitch, but I think it's quite a good time to get involved in a fund like the Prescient Balance Fund, which picks things in a different way on a yield type strategy. Just looking at us versus what I think is the key to this fund as a whole, this fund looks to outperform the peer group through time on a relatively consistent basis. On the shorter term periods, just to explain this chart, this is the percentage of time that we've spent in the various quartiles versus multi-asset high equity as a peer group. So on the shorter term perspective, yes, we do spend some time in the 4th quartile. It's very rare, and we're in one of those periods at the moment. But in general, we spend more than half the time above average. That's in the 1st and 2nd quartile. If you extend that out to longer and longer time periods, again, very small period where we're in the 4th quartile, also a small period in the 3rd quartile, the majority of time above average, and bring that all the way out to 3-5 years, we're always above average on a rolling basis. And that's what this fund's looking to do. When we are underperforming, we're underperforming by single-digit percentiles, if not basis points, and that's what keeps us up at night. And I think that's important, just to keep your minds at ease, that for us, that's something we're trying to improve. It's not like we're underperforming by 20%. We're peer group cognizant, and we think that there's a very strong embedded yield within these funds going forward from here on out. With that, I'm going to hand back to Davy if there are any questions.
Thank you, Rupert. Yeah, there is a couple that's popped through. I think let's go to the inflation one first. If the market does not expect inflation to stay higher for longer, evident in the curve that you've showed, the risk is then that inflation will actually be higher for longer. What, in your view, will be the first signs that inflation will stay higher, and what will the effects or after effects of that be?
Yeah, John.
Yeah, I can. Yeah, we can certainly try to answer that, given that it was a theme that we did focus on for quite a while, just trying to navigate there. But what we'll try to do is to understand which components of inflation tend to be much more long-lived versus other ones. So let's see. Oh, right. So if we look at US inflation as an example, which we've tried to break down into its component drivers, and so I'm just waiting for the page to load.
I think, well, I'll just do that. I think one of the keys to that is if we look at, so inflation prints are retrospective. And if we look at the key drivers that caused this inflation spike, it's been things like oil, it's been natural gas prices. Oil's come off significantly, well below 100 now. So we expect that to translate through time into these components that Odwa will take you through.
All right. So just to give you a quick overview of like what has been atypical, let's call it, of this current inflation period. So there are a few interesting components that are of inflation that are more supply side driven, right? So think of it, you know, from the slowdowns we've had from COVID and the continuous lockdowns that we see in China, and even part of it's driven by the current war. So if you look at new and used car vehicles, what this picture is saying is that historically, this particular component has contributed on average 0 to annual inflation in the US. However, now it's contributing close to 2%. And all of a sudden, it's literally the highest single contributor to inflation compared to historically. So a supply side driven type of event. And if we can unlock the supply side issues, or at least if they don't get worse, right, then this number, we don't expect those prices to increase further. And this component can either go to 0. However, if the supply chain constraints are unlocked and prices revert back to what is, let's call it reasonable, this can even have a negative contribution from that component. So that's one of the reasons, you know, like to think of it from that way. Then another one that is contributing quite a lot currently is motor fuel. Again, this is very much linked to the oil price. But what is interesting here is if you look historically at how much oil has contributed to inflation, you see that it's all over the show, right? Given how volatile that particular commodity is. So given that it more than doubled recently and has contributed more than 1% to this 9% number, if it essentially remains where it is now, around $100 per barrel, even that will start to, as time moves forward, will start to have a diminishing impact on inflation. However, for it to continue to have a high impact, we'd expect oil prices to keep on increasing and to contribute to a similar level, maybe start seeing prints of around $180 dollars per barrel. And I don't think anyone would want to see those days anytime soon. So that's really the narrative. So, but what would maybe be a bit more worrying is to have maybe sticky high shelter prices, as an example. Therefore, that would be a bit of a problem. But if these two get resolved, then we're in business. Or even if this guy does not get resolved, but the supply chains don't contribute to higher price increases than what we've seen in the past, that will just have this natural reversion to zero. So that's part of the underlying rationale by looking at the actual prints themselves, over and above the market expectations that we've then looked at, which are a bit more forward-looking as well. So that's really about it from that perspective. I hope I've answered at least that question to some extent.
Yeah, I think so. Thanks, Odwa. Maybe one or two more. How much of a US recession is priced into the S&P, do you think?
Yeah, so that's an interesting one. I think that's a theme that we're seeing across a lot of asset classes, and that is, I showed you those returns on asset classes that have happened already year to date. This is not like a normal type of recession or market sell-off. It's been slow and it's been drawn out, which means that it's in essence, it's to a large extent priced into the market, right? That said, I mean, Odwa's not going to the valuation side. There is still room to fall in the United States on a price basis, but we're coming into earnings season right now, and quite a few of the companies are publishing relatively positive earnings, which will lift the earnings profile on the PE ratio, which in turn brings the PE ratio down. So, the thing about this sell-off is that it's priced, what we've priced on the curve is inflation, which is way out of control, hikes which are not like nothing we've ever seen before. Essentially, the market is priced for an apocalypse already. And we just don't think that it's going to be nearly as bad. I showed you in the beginning that we're showing a 50-50 type chance of a recession. We think at the moment that recession would be shallow, which means that there is certainly value in different asset classes around the world to take advantage of this sort of, the usual thing is fear and greed. And at the moment, there's a lot of fear priced in the market. And a lot of guys are starting to say, well, asset managers are starting to say, well, actually, there are quite a few opportunities now. So let's start getting involved again. Yeah,
and maybe Rupert also showed the wage and unemployment figures. So again, it's almost like we are heading into the uncertainty, but with people being employed and having good salaries, i.e., there is still some support from the demand side of the equation, which really does help on that side. And even if we do head into a slowdown economically, it's not like the other case where there's no demand and like there's just a gradual slowdown in the economic activity. So that also again helps to ascertain that this might be a shallow slowdown from that perspective.
Cool. Thank you. I think we're going to leave it there with the questions for now. Thank you for everyone who's joined today's session. I hope everyone found it insightful. Just as a reminder, we are running our first in-person roadshow throughout the country over the next 2 weeks. If you have not received your invitation or probably missed it or possibly missed it, please reach out to us if you would like to attend, and we'll put you on the list. Due to the roadshow taking place, our fixed income webinar will only be taking place on the 18th of August. So look out for that reminder. Yeah, with that, thank you, Rupert and Odwa, and have a great day further.
Yeah, thank you everyone for your time.
Thank you so much. Have a good day.
Cheers.